Namaskaram everyone, this is Nishanth Reghunath here and welcome to a new video from KYDU's Financial Management Bootcamp. Yes, so this is the second video for cost of capital, and with this video, I hope to complete the whole chapter, alright. And by completing the whole chapter, I'm not referring to doing like n number of questions and everything, but just the concepts, alright. So where did we leave? Where did we leave last class? Yeah, this is where we left off. So this is the last thing I wrote, and if you remember correctly, I had mentioned the whole chapter for cost of capital involves a lot of formulas, calculations and everything. And that calculation or those particular formula based calculations are done for each security and for a company as a whole. So let me quickly summarize what cost of capital is. Every owner brings in money to a business with an expectation. And what is that expectation? That the business use the money properly, invest it properly, and by using and investing properly, the business generates good return. And from this return, the business is able to pay back to the owners their expectation. And always remember, higher the risk in an investment, higher will be the expectation. This particular expectation which the business has to pay back to the owners is termed as cost of capital. Alright, so as I said, higher the risk, higher the expectation. Yes, higher the expectation, higher the cost. So it goes without saying, equity share capital will have the most risk when you compare debt and equity instruments. So equity instruments will be on the higher risk because they only get return when the business makes something, unlike debt. See, we know if you buy a debenture, regardless of how the company performs, you will be paid interest. Yes, whereas equity dividend, now that's an issue. An equity shareholder will only get dividend if the company performs well, makes money, pays off all the debt holders, and pays the preference shareholder, and if at all they have something left, they'll give to the equity shareholders, correct? So just keep that in mind. So what we are going to do right now is, we'll be taking either a security, let it be just a security. Now, we'll be finding the cost of the security. Now this cost we'll be finding at a percentage. Now, how will we structure this formula? Just follow this ideology or just follow this particular structure that I'm giving you, blueprint that I'm giving you. This cost percentage will take a structure of item of cost on numerator, okay. Whatever proceeds we got from the security as denominator, and at times might have a special attachment. So for example, if I am taking a debenture, so I am a company, I issue debentures. Now my debenture holders will have an expectation. What is their expectation? That I pay them interest. So my item of cost is interest. So my item of cost, interest, will be my heading, numerator, divided by whatever I am getting from that debenture. Say it's a 100 rupee debenture, 200 rupee debenture, whatever I am getting as a company, as a debenture issuer, whatever I am getting, that I'll write it below. I'll write my proceeds below. And I will establish this as a percentage depending upon whether I have a special item or not. So for example, if I have a debenture which is of 200 rupees, say, so proceeds it's 200 rupees. And my interest component is say 10%, so 20. It will be 20 divided by 200. But for debentures, always remember, there will always be a special attachment, and that special attachment we'll learn. The reason why I gave you this particular explanation is because so that you understand what component goes as a numerator and what component goes as a denominator. So numerator component is always cost, that is interest. Or if it's a equity share, it will be a dividend. If it's a preference share, it will be preference dividend as a numerator. And on the bottom, it will be whatever that we are getting from that security as a company. So I issued that security, what am I getting? Net proceeds, and make sure it's net proceeds, okay, net. That is proceeds minus any flotation cost or anything of that sorts. Alright, clear? Now shall we go to our chart? Okay, so this is where we left off. Cost of capital. So as I said, we'll be finding it for each source. As each source, I mean each security, and for the company as a whole. That's overall. WACC stands for weighted average cost of capital. So each source we have three kinds to learn. Sorry, I'm so took the wrong chart. For each source we have three to learn. For debt, for preference shares, and for equity. So preference shares, I haven't given what to call it. Oh, sorry. Preference share, we'll call it as KP. Okay. So every formula, see, every cost of capital element, see, if it's for debenture, it will be termed as K small d. For equity shares, it will be K small e. For preference shares, it will be K small p. So every cost of capital will follow this particular K. K is the alphabet that we'll be using. So KD, how do you find cost of debt? So the first one that you need to check is whether the debt is a term loan or a debenture. Is it a loan or a debenture? So if it's a loan, how is it going to be? So as I said, what should be in the numerator? Cost should be in the numerator. So for a loan, what is our cost? As a company, we took loan. What will be our cost? Interest. So our numerator will be interest. Okay, so sorry. Interest divided by 1 minus T. That's a special attachment. Let it be there. Not divided by interest multiplied with 1 minus T. The whole divided by net proceeds. NP stands for net proceeds. Let me just make a small change the arrangement. Yeah, this is much better. Interest into 1 minus T divided by net proceeds. Now let me just write this down so that I can explain it to you better. So loan cost of capital, or take this off. For a loan, cost of capital is, we are going to call it as KD. That's what we called it, KD. Numerator being interest, denominator being net proceeds, whatever we are getting from that loan. And that special attachment. The special attachment for debt instruments is always 1 minus T, wherein T stands for the company's tax rate. The reason why we do a 1 minus T here is because whenever we are paying interest, we always get an interest tax benefit. Because we pay interest before paying tax, right? And because of the interest that we pay, our income reduces. Our income reduces. Say my net profit or gross profit, or let it be earnings before interest and tax. Earnings before interest and tax is 200. Okay, I'm paying an interest of 20. So my EBT is 180. Say my tax rate is 10%. So I'm paying tax at 18. So my EAT is 180 minus 18, 162. Alright. Now since I paid interest before paying tax, what happened? My earnings reduced to 180, hence my tax also reduced. So if I hadn't paid interest, my earnings would have been 200 and my tax would have been on 200, that would be 10%, 20. So because of interest, my tax amount reduced, right? So I have a tax benefit because of interest payment that I'm making. Alright. So that's all that I'm doing here. So here it will be, so I'm just taking this exact same case, okay. Say the debenture was for 200 rupees. So my cost will be like interest component 20 into 1 minus T. So 1 minus 10%, tax 10%, right? So 0.1, 1 minus 0.1 divided by proceeds 200. So it will be 20 into 0.9 divided by 200, and 20 into 0.9 divided by 200 will give you how much? It will be 18 by 200. Now how much is this? 0.09, and it can be expressed as 9%. So your cost of this loan is 9%. So remember, cost component, interest on top, divided by whatever you are getting from that loan, into 1 minus tax rate. Clear? Simple, right? Very, very simple. Yeah, that's it for loan. Now let's go to debenture. In debenture, you have two kinds, and by the two kinds, what I'm referring to are debentures which are redeemable and debentures which are irredeemable. Yes. So for redeemable and irredeemable debentures, you have calculation which happens in two ways. So let's check redeemable debentures first. For redeemable debentures, the format is pretty similar to what you saw in loan, but it has an extra additional attachment. Okay, let's go to irredeemable first. Irredeemable has the exact same format as loans. So interest into 1 minus T divided by net proceeds. No difference. Interest into 1 minus T divided by net proceeds. Okay. Irredeemable debentures are also referred to as convertible debentures. Okay. Now redeemable debentures are debentures which holds a particular feature which enables this particular debenture holder to redeem it, as like sell it back and claim a value. So when a debenture is redeemable, always remember the formula will have a special attachment which includes the redemption value. So it starts off with the same interest into 1 minus T. But here is where the change comes. So if you check here, it might be a bit confusing. I'll explain it to you easily right now. So this is how it's going to be. KD equal to interest into 1 minus T. That's the first part. Alright. Let's check the second part. Plus RV minus NP divided by N. So plus RV minus NP divided by N, and this whole divided by same RV and NP, but not minus, rather plus, divided by 2. Alright. So interest into 1 minus T is the same. The change came in form of the redemption value. This is a new feature that this debenture has, right? So what you do is you take the redemption value. Say the question says debenture of 100 rupees which is redeemable at say 120. So 120 is the redemption value. So 120 minus whatever we got of the debenture. Say we issued it for 100, we got 100. So 120 minus 100 divide by N. N refers to the tenure of that debenture. Say it's a 5-year debenture, 8-year debenture, 9-year debenture, 10-year debenture. Divide by 10, divide by 5, divide by 8, divide by 9, whatever the period of the debenture is. So you take the redemption value minus net proceeds divided by tenure, and whole divided by redemption value plus net proceeds, the whole divided by 2. Also one more thing, please do remember, if you are doing cost of capital, make sure if you start off with the interest component or cost component of a single security, then you take RV and NP and everything of single security. The reason I said that is because, say the question has, company has a total debenture of 100 each, okay, 100 each, value at 2 lakhs. They issued it for 2 lakhs. Now here you can either take debenture net proceeds as 2 lakhs or debenture net proceeds as 100. Now if you are taking it as 100, that is the debenture value, single debenture value. So 100 rupees debentures, they issued 2,000 of them, that's how they generated 2 lakhs, right? So either take 100 and calculate interest for that 100, do redemption value of that 100, do net proceeds of that 100 and everything. So if I am to give you, if I am to extend this example, the company also says these debentures are redeemable at 120 each. Now you have this question, and their interest component is 10%. Company's tax rate, company's tax is 30%. This is how it's given. There are 2 ways you can do the answer. So I'll show you number one, by just following single security value. So single security value, what is interest? Interest is 10%, right? So 10% of 100. So 10% of 100 is 10 into 1 minus 0.3 plus what is the redemption value of the single security? 120. 120 minus net proceeds is 100, the whole divided by N. Say this is a 5-year debenture, divided by 5. The whole divided by 120 plus 100 divided by 2. This is how you do based on a single security. Now if I am to do with the whole security value, so whole debenture value, debenture issued value, it will be interest is the cost 10%, but not on 100, I will be doing it on 2 lakhs. So 2 lakhs 10% is 20,000. 20,000 into 1 minus 0.3. Yes or no? Agreed. 20,000 is 1 minus 0.3 plus what is the redemption value? 120 each, right? So 120 each, 2,000 debentures of 120 each. So it will be 2,40,000. Correct? Minus 2 lakh. Correct? The whole divided by tenure being 5. Alright, scrolling it a bit. And the whole divided by 2,40,000 plus 2 lakh divided by 2. So here I took the interest for the whole value of debenture, the whole book value of debentures that I have. So I'm supposed to take redemption value and net proceeds for the whole value. But here I took interest for just one security. So the redemption value and net proceeds I'll be falling for one security alone. Always remember this. Do not forget. Okay. Yes. So N is tenure, RV is redemption value, NP is net proceeds. So remember interest into 1 minus T plus RV minus NP divided by N. The whole divided by RV plus NP divided by 2. Now we are going to preference shares. Pretty simple, pretty basic. Here also we have redeemable and irredeemable. That's a convertible and perpetual debentures. So how to find value? Pretty simple. So what's the cost for preference shares? What is the cost for preference shares? It is preference dividend, right? So we know the cost of capital formula. KP should be the cost divided by your net proceeds. In case you have a special attachment, you multiply. So for preference shares, the cost of capital formula should follow. Since the numerator is always cost, it should be preference dividend by net proceeds. Correct? Because preference dividend is a cost for preference shares. Correct? So let's check. This preference dividend into special attachment divided by net proceeds. Now the special attachment is not compulsory that will come for every case of preference share. Whereas interest component 100% sorry, not interest, tax component for interest 100% pakka. For debt, you'll always have the 1 minus t here, 1 minus t here. Okay, you'll always have it. But for preference shares, you might not have it in all cases. And also if you noticed, here it's 1 minus t, here it's 1 plus DDT. DDT is also a tax, it's called dividend distribution tax. I'll tell you why we are doing 1 plus DDT here and why we did 1 minus t on the other case, that is in debt case. See the company, our previous case. What shows our earning after tax is 162. Our earnings after tax is 162. Company is paying a preference dividend of say 60 rupees. So they have a balance of 102. Now when the company pays the 60, there is a law that states that they have to pay a dividend distribution tax. Now along with the 60, they have to pay 10% DDT. That means not just 60, they'll have to pay 10%. That's an additional 6. Additional 6. So that means because of preference dividend you are paying, you are not getting a tax benefit, you are getting an extra tax burden. This is an extra thing that you are paying, correct? Extra thing that you are paying. That's why here in formula it's preference dividend into 1 plus dividend distribution tax. Now this might not be there for every question, but in case the question says preference dividend is applicable, dividend distribution tax is applicable for preference dividend, you add this as an extension to your formula. Alright, simple. Now if the preference dividend is redeemable, the cost will be similar to exact same debentures. If debentures were redeemable, what was the cost? There's interest into 1 minus t plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Here will be preference dividend. If you have DDT, 1 plus DDT, if you have only, okay, plus RV minus NP divided by N, whole divided by RV plus NP divided by 2. So the extension RV minus NP divided by N, RV plus NP divided by 2 is the same here and here. See, same. Let's go back to our chart. It's redeemable. See, preference dividend into 1 plus dividend distribution tax plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Always remember, unlike debt, for preference, the additional attachment of tax, that is 1 plus dividend distribution tax, shall not come for every case. Whereas for debt, the 1 minus t tax, that tax will come for every case because that tax is company's tax, the tax that the company pays. Whereas this tax is dividend distribution tax, which is currently not applicable for our country. It has been removed. But in case the question says dividend distribution tax, then you make sure that you include it as an extra attachment. And for your preference, it's always 1 plus DDT. For debt, it's 1 minus DDT. Clear? Now cost of equity. There are 5 methods here that I've mentioned. But these 5 methods, it's not necessary that you learn all. It's pretty simple. I'll take you through one by one. Okay. So first one, method based on what is made by the owners. Second one, method based on what is distributed to the owners. Third one, method based on what is not distributed to the owners. See, in our previous example, after paying preference dividend of 60 and a 6, how much do we have left? We have left 96. This is what we have left, right? So 60 and 6. So we have 96 left. This 96 is what the company has made, what the owners have made. Now it's not necessary that the company pays everything that they've made as a dividend. This is what they made. Now this is earnings per share. This is earnings per share. Or earnings. Let this be earnings. Let this be earnings. Sorry, not earnings per share. This is the total earnings. This is the earnings. Now out of the earnings, say the company decides to pay 50 as dividend. And the balance 46, they decide to keep it as retained earnings. Possible, right? Now we'll be finding the cost of equity based on 96, we'll be finding cost of equity based on 50 and based on 46. That's what we saw here. Based on what is made by the owners, what the company made, 96. Based on what is distributed to the owners, what the dividend was paid, 50. Based on what is not distributed to the owners, what was our retained earnings, 46. So on these three bases we'll be finding. Okay. So first and foremost, what is made by owners, this method is called earning price method. Okay. Here and here we have two particular methods of finding cost of capital. Method number one, no growth model. Method number two, growth model. Same for dividend as well. So for no growth model, simple. Cost of equity equals EPS, that is the earning per share divided by market price. So this is the earnings that's made by the company. Say it's 96,000. Say it's 96,000. And they have 1,000 shares, right? So what is the earning that is made by one share? 96,000 divided by 1,000, that is 96. Correct. So you take 96 divided by, say the market price of the share is say 100 or 150 or let it be 100. Market price of the share is 100. So based on that data, for a share which has a market price of 100 and for a share which has a market price of 100, it earned 96, then the cost of capital will be 96 divided by 100 into 100, that is 96%. No growth model. Alright. Now, if it had been a growth model, something additional will come to the formula. EPS divided by MP will be there, but then you'll add something. Plus G. Plus G. G stands for growth rate. Alright, G stands for growth rate. Alright, now that will be given in the question as well. The company expects a growth rate of 30%. Company expects a growth rate of 20%. Company expects a growth rate of 15%. This will be explicitly mentioned in the question. Okay. Now say in our case, the company expects a growth rate of 10%. Then the only difference to formula will be 96 divided by 100. This is earning per share divided by the market price of the share plus G, right? G is 10%. Our case is 10%, right? So 96 divided by 100 plus 10%, right? So 10% is 0.1. 0.1. So 96 divided by 100, how much is it? It's 0.96 plus 0.1. And that is 1.06. If expressed as percentage, you just multiply with 100, you will get 106%. So 96% grew to 106%. Clear? So that's all that you have to do. But make sure, a major mistake that students make here is, I'll show you. See here I took 96 divided by 100 plus 0.1, right? So I'll get it as 0.96 plus 0.1. So I'll get it as 1.06. You know what's a mistake that students will do? Students will do 96 divided by 100 into 100 plus 0.1. Now what they'll do is they'll find out 96%. They'll do 96% and with that they'll add 0.1. Should be 96.1%. So they will multiply this 100 inside the formula. They'll multiply this 100 inside the formula. So what happens is the percentage is established and with that they add a 0.1. No, don't do that. You do all the calculations, find the last value and then convert it into a formula. Also another mistake that students can make is, see they are taking 96 divided by 100 plus growth rate of 10. So it will be 0.96 plus 10. That will be 10.96. Now they will try to establish as a percentage. They multiply with 100. That will give you 1096%. Okay? So don't make that mistake. So your EPS divided by market price plus G should always be expressed as a decimal. Alright, or you can do one more thing. If you want to express it as 10, you want to express it as growth rate as 10, then do one thing. 96 divided by 100 into 100. Do that plus G 10%. So this is 96% plus 10%. That is 106%. Correct answer. 1.06. 1.06 into 100 is 106%. Correct. Yeah, so either follow decimal everywhere or don't follow decimal everywhere. Follow percentage everywhere. Okay, so that's all for equity shares. Then equity shares cost of capital is computed based on earning price. Now for dividend, no growth is similar. No growth is similar. Cost of equity equal to D1 by P0. Now In this case, our dividend was 50, right? Dividend was 50. So you take 50, cost of equity will be D1 by P0. P0 is opening market price. Price of the share in the beginning of the year. So D1 by P0, it will be 50 divided by, in our case, 100. So 50%. 0.5 or 0.5 can be expressed as 50%. Say, imagine this case there is growth. The company is expecting a growth of 10%. Then what happens is also one more thing. In no growth model, always remember the dividend does not change. Dividend is always the same. In growth model, dividend changes. The formula will be D1 divided by P0 plus G. So since in no growth model dividend does not change, let's not have it as D1. Let's just simply have it as D. Okay, let's just have it as D. Strike off this as well. And growth model, the change in formula will be, instead of D, it will be D1 divided by P0 plus G. Say the company is expecting a growth rate at 10%. Previous year's dividend is given. Say the previous year dividend is 50. 50 is the previous year dividend. Now here what you should do is, from the previous year dividend, which is D, you need to find D1. Now D1 is equal to previous year dividend, D into 1 plus G. So what is D? 50 into 1 plus 10%, 0.1. So 50 into 1.1, that is 55. This is the dividend expected after growth. So in the question, please be very careful. If the dividend of the previous year is given and growth rate is given, and if you are supposed to find out growth model cost of equity, you need to take previous year dividend, multiply it with 1 plus the growth percentage, and get the expected dividend of the new year. So D1 is 55. D1 will be 55 divided by P0. P0 is 100 plus growth rate of 10, that is 0.1. So 55 divided by 100 will give you how much? 0.55 plus 0.1 will give you 0.65. So the dividend percentage will be 65. Dividend growth model percentage will be, cost of capital will be 65. Clear? Simple, right? Very, very simple. Coming back, we saw no growth and growth, all done. Yes, and at times this G will not be given explicitly. We will have to find G. G is also calculated as per the following formula, that is B into R. B is retention ratio, R is return on investment. Retention ratio refers to the percentage of retained earnings in a company. Say, the company has a total earning per share of 100, out of which they give a dividend of 60. So their retained earnings is 40. So it's fair to say their retained earnings as a percentage is 40%. That is 40 divided by 100. Correct. This is their retention ratio. Okay. Say the company has also given their return on investment. Return on investment is say 20%. So growth rate of G is equal to 40% into 20%. Clear? Yes or no? That is 8%. Clear? As simple as that. Fine. Now coming to the last one, that is cost of equity based on what is not distributed. This is a retained earnings approach. Here we have two different models. One is a discounted model and CAPM model. And discounted model is the same as dividend growth model. The same one, exact same one, no change. Cost will be D1 by P0 plus G. Nothing much, the same one. Whereas for CAPM model, you have a very, very interesting very interesting formula. Now we learn CAPM model as it is as well. Let me scroll this down a bit. We have CAPM model as it is as well. This is the same here for retained earnings CAPM method and normal CAPM method is the same. The cost of equity will be RF plus not B, beta into RM minus RF. Now I'll quickly explain what these items are in the formula. RF stands for risk-free return. Beta is a statistical tool which is also a measure of risk. It's also called systematic risk of a company. RM is the return of the market and RF is again risk-free return. So always remember, RF is risk-free return. Okay, RM is return on the market. Beta is systematic risk. All of this will be given in the question. Let me see if I can find a question and just explain all this from that question, because else it will be a bit confusing. Yeah. So found one question. Illustration 18. From the following information, determine the cost of equity capital using CAPM model. Required rate of return on risk-free security. So RF, you got risk-free security return, yeah, 8%. Required return on market portfolio. So you got RM 13 and beta is 1.6. So formula is RF, that is 8 plus beta 1.6 into bracket open 13 minus 8. Simple. You have another question here as well. Just go through this question as well. Here they have asked you to find out one more item, that is the equilibrium price. I'll be teaching how to calculate equilibrium price as well in the coming videos, or probably by the end of this video. So you will find out the equilibrium price as well. So equilibrium price, anyway, I'll teach it right now itself instead of delaying it any further. Equilibrium price is pretty basic. You take the new dividend, that's a grown dividend. You have the old dividend, you have the growth rates. So D plus growth, you will get you D1, how we found out earlier. So you find out D1 divided by cost of equity. You know the cost of equity from this particular previously calculated 17 here. That's 17 minus whatever your growth rate is. Okay, so for example, say my D normal D, my dividend from last year, that is before growth. Why is my glitching? Yeah, dividend is 100. My growth rate is 8%. My cost of equity, say from this previous question, let's find out cost of equity as well. The beta coefficient of a company is 1.4. So beta is there. The company has been maintaining 8% growth rate in dividends and earning. The last dividend paid, okay, D0 is 4. Okay, D0 is 4. So I'll just take the exact same question. Okay, D0 is 4. D0 is 4. Growth is 8. And beta was 1.4. Beta was 1.4. The return on government securities is 10%, while the return on market portfolio is 15. Now RF is 10%. RM is 15. Now you might ask, how did I know that the return on government securities is my risk-free return? See, risk-free return refers to the return that you get from securities which has no risk. So it's wherever it's the safest to invest. Like government bonds hold no risk at all, right? So wherever you can invest and you have zero risk, that's called risk-free return. The rate of return that they give is called the risk-free return. So here government securities are good. Government securities are the ones which have least risk. The current market price of the share is 36. Current market price is 36. I am not sure why they gave that data. Okay, let's check. What have they asked? What will be the equilibrium price of that share? Would you advise purchasing that share? So what should you do? Okay, let's see. So current market price is 36. So cost of equity is RF plus beta into RM minus RF. See, so whenever you are finding cost of equity, so you are going to invest in a company. So you know your government gives you 10%. So you should at least get that 10%. So I am putting RF first. You should at least get that. Plus the market, that particular sector, say this is a textile sector. Textile sector in general is performing at 15%. So you know the textile sector is performing at 15%. Okay. So it's 15% over 10%. So over the no risk government textile company, you are getting an extra of 5%, right? But this particular company that you are investing is doing so well that it is even performing better than the market. Say the company is performing and they are getting like 25 or 26 or some percentage they are getting. Now, if the company is performing better than the market, their beta will be a value higher than 1. So 1.4 states that the company is performing better than the market. So that's why 1.4. So if it had been beta 0.8, that means the company is performing not as good as the market. So what will be the answer here? 10% plus 1.4 into 5%. Yes or no? 10% plus 1.4 into 5%, that will be 10% plus 7%, that will be 17%. See, so the premium that you got by investing in this company is 7%. Correct? 10 you would have got if you invested in the government. Generally, the market would have given you 15, But here, since the beta of this company was strong, you are not getting 15, you are getting over and above the market return. You are getting 17%. Okay. Now let's find the equilibrium price. Equilibrium price. Equilibrium price is nothing but D1 divided by cost of equity minus G. Now what is our D1? We don't know. We'll find out. D1 equals D0 to 1 plus G. It's not necessary that you write as D0. You can write it anyway. You can just write D. What is D? 4 into 1 plus 0.8. So it will be 4 into 1.08. Correct? And that will give you 4.32. Not sure. Let me just get the calculator. At times my math is weak. My calculation goes weak. 4 into 1.08. Yeah, 4.32. 4.32. So equilibrium price will be 4.32 divided by, what is my cost of equity? 17%, right? 17% minus, what is my growth rate? 8%. So 4.32 divided by 9%. Let's check how much that is. Let me get my calculator quick. Where is the calculator? I just opened it. I closed it. Closed it. So 4.32 divided by 9%. Sorry. 4.32 divided by 9 into 100. 48. The equilibrium price is 48. This should have been the price of the commodity. This should have been the price of the security, not commodity, security. So that's what we found out. So D1 we found out like this, divided by KE minus G. Clear? Now the price of the security should have been 48, but currently the market price is 36. Currently the price share is going for 36. That means the value of the share is currently pretty low. This is a good time to purchase because this company could have sold it at 48 because they are giving growth and returns in such a rate that the value of the share should have been 48. But right now it's just 36. So what should you do? Buy. Go buy the share, man, because it's at a good deal right now. Let's see what's given in the question. 1748, the shares of target limit is worth buying as it's undervalued. Yeah, it's valued at 36 because the value is currently low. You can buy it now. It should have been valued at 48 or somewhere higher. Yeah, so buy. Clear. That's it. Now coming to one method that we left out, that is realized yield. This is pretty simple, but then please do keep in mind, as far as cost of capital is concerned, not much questions come from realized yield method. Also, this particular method has a connection with the chapter capital budgeting. That is the chapter for wherein we actually use the concept of time value. Okay. So what is the realized yield method? By realized yield, all that it refers to is whatever you have realized. Whatever you have realized from a security. So you can realize from an equity share, since the security is a cost of equity here, what all can you realize? You can realize dividends here, right? And say you are selling off a security, you can realize gains. Say I bought a security for 100 rupees. I got dividend of 25 rupees. I sold the share for like 200 rupees. So what all am I realizing from this share? 25 I am realizing as dividend. Then I am realizing a gain. I bought for 100, I sold it for 200. So I am gaining an extra 100 also. So 100 plus 25 is my gain. Yes. So here in realized yield, my calculation of cost of equity will depend on an average rate of return, which is based on past few years data, wherein we check all the dividends that we have received, all the gains that we have realized. Now, based on the dividends and gains that we have realized, we set an expected future return. So, past, I have realized dividend in first year 20, second year 30, third year 10, fourth year 10. So, I will take all the dividends. In 1 year, I am selling this share. And I'm getting a gain also. This particular gain. Where's my pen? I'm getting a gain also. I take all the dividends I got. I take all the gains that I made. I'll create a percentage which I will use it to predict or set an expectation for my future return. So we'll do a question. I'll give you an example. Okay, so the example that I'm giving to you is the exact same example that was given to me in my class by my teacher, C.A. Raja Natarajan, when he taught this particular concept. So I have my book open right in front of me. Okay. So say Mr. X purchases shares. Okay, he purchases equity shares of 1000 rupees. Now for this 1000 rupees share, he receives dividend for 5 years at say 10%. Now at the end of fifth year, he decides to sell this share for rupees 1128. So he bought it for rupees 1000. He's selling it for 1128. So clearly we know here is a gain of 128 rupees. Also, he's realizing 10% dividend for 5 years. So what is our realized yield? Dividend for 5 years and gain of 128 rupees. Correct. Now, how do you calculate this? That I'll show using an Excel table. Let's create a table. Let's zoom this in a bit. Okay, so this question has 5 years, right? So years 1, 2, 3, 4, 5. The dividends that I've got 10%, right? And the cost of the equity was 1000, so 100 every year. 100. What is the gain that I've got? Gain I got at the 5th year, correct? Gain I got at the 5th year, that is 128. Okay, let it not be gain. Let it be sale value. Let it be the sale value. Alright. Now, what realized yield tells us is that your cost of equity will be the rate at which the present value of your total gain. So what's your total realized value? Is this plus sale value. So why did it become percentage? This is the total value, right? So if I am to total here, it's 1628. No need of currency. I'm not sure why it goes to currency. 1628 is my total. My cost of equity will be let me just get my pen. My cost of equity will be the rate at which the present value of 1628, that's my total return, equals the present value of my investment. Investment is 1000 rupee share. Okay. So present value of investment is 1000 itself. So PV, when the PV of 1628 equals 1000, that rate which gives that particular PV will be my cost of equity. Alright. So what we need to do here is we need to find the percentage which gives the PV we need to find the percentage which gives the PV of 1628 as 1000. Alright, that's what we have to do. So let me just delete this, or let me just move this, or even better, I'll just copy this and paste it down. Once it will interfere with what I've written. So what I need to find out right now is I need to find out the rate at which the PV of 1628 equals 1000. So I need to find out the rate which gives me PV of 1628 as 1000. So I cannot right away fix on a value and say I'll take 10%, 10% will be the rate, 3% or 12%. I cannot do that, right? So all that I can do is I can follow a trial and error method. Say for first I'm taking 10%. So let's check discounting factors at 10%. So 10%, what will be the discounting factors? Be 1 divided by 1.1 raised to your year. Yes, so 0.909, like that for all the years. Now what will be my PV? So whatever I have realized into this, correct? So to drag it all the way down, and the sum is, how much is the sum? I'm getting it as 1079. So currently my PV of 1628 is higher than 1000, correct? It's 1079. That means I need to discount it even further. I need to bring about a bigger discount factor so that my value gets reduced. Correct. So I need to find out a discounting factor which is going to reduce my value. So as a trial now, let's take 12%. So initially we took a 10% discounting factor. the rate of return, and that did not work because that gave us a higher value for our PV. Now let's take it at 12%. Let's take it at 12%. Okay. So let's see what happens when we take it at 12%. So discounting factor at 12%. Now, in case if you are not able to understand what I'm saying right now, because if you haven't studied the initial chapters of time value of money, or you do not know the concept of time value of money at all, what I would suggest is go to the first chapter's video, then come back, understand what time value of money, understand what discounting is, understand what compounding is, then come back here. Or you can go to capital budgeting and learn that chapter and come here as well. Yeah, so I'm going to discount at 10%. So what's the format? So what's the formula for discounting? The formula for discount is simple. 1 divided by 1 plus r raised to n. So initially it was 1 divided by 1 plus rate was 10%, 1.1 raised to n, where n is the year. So it will be now 1 divided by 1 plus r is 0.12, 12% raised to n. So it will be 1 divided by 1 plus 0.12, correct, raised to n. My each year return is 1, correct. So now I'm going to add all this up. Yes, now I'm going to find my PV. My PV will be nothing but total realized into the current discounting factor, correct. Now I'm going to find out for all the cells. Yes, now I'm going to add it up. I'm going to get 1000.53511. So very close. It's at 1000. Yes, but then still there's a small difference, decimal difference. Now, if you want to get it more accurate, so I can say, so currently based on the data that I've got right now, I can say 12% is my cost of equity, because it's at 12%. At 12%, the PV of inflows equal to investment, PV of investment, investment PV. That is, PV of inflows was 1628, right? So PV of 1628, PV of 1628 at 12% equals rupees 1000. Yes, but say you want it to be exact 1000, it's 1000.531511, right? What you can do is apply the approach that we do in IRR, in capital budgeting, internal rate of return technique. Apply that particular approach, that technique, and then find out to the point what is the most accurate decimal that I need. So 12 point something, it should be 12 point something. You can find out by doing the IRR technique. You can go to the IRR video and find that technique there and apply it right now here. Alright, so I'm not going to explain right now because it's going to make the video unnecessarily lengthy, and as far as cost of capital is concerned, you will not be given any question as from this area of realized yield much. You won't get such complicated questions. Alright, so with that said, we have come to the end. I think we finished everything, right? Yeah, we didn't finish all the 5 items. So we finished cost of equity, finished cost of debt, and we finished cost of preference. So coming back to my note, always remember, cost of capital will follow a particular structure. Numerator will be cost, denominator will be net proceeds. Okay, and at times there will be a special attachment. For debt, it will be KD, it will be interest into 1 minus T divided by net proceeds. If there is redemption value, you will have a special attachment, that is plus RV minus NP divided by N. Instead of net proceeds on the bottom, you will have RV plus NP divided by 2. Yes, just like that. For preference, we saw what happens. If there is redemption, there will be RV minus NP divided by N divided by RV plus NP divided by 2. Instead of 1 minus T, it will be 1 plus DDT, and that is applicable only if it's mentioned in the question. DDT is dependent upon each scenario, whereas this T for debt, the 1 minus T will be there for every case. So please do not forget that very, very important point. For debt, there will be tax in the formula for sure. That's the company's tax rate. Whereas for preference shares, the T, that is DDT, is dependent upon each scenario. So yes, we are done with cost of capital for each security. So we finished cost of debt, we finished cost of preference, and we finished cost of equity. Always remember the structure of the formula. The cost item on top divided by the proceeds. At times it will have a special attachment. Always remember that, okay? Now, before I wind up, I'm requesting you to show me some love. Just like my videos, share my videos, comment, subscribe to my channel, bring in more traffic. just show me some love, okay? So that's all that I have to say, and I'm winding up this video. This is Nishanth Reghunath signing off from yet another video of KYDU. I'll see you in my next one. Bye bye and take care.